This is the part of the show where we put a fund in the spotlight, and this week we're reviewing the Atlantic Real Income Fund, and could be a fund that is benchmarked against CPI plus 3.
Yeah,
that is the target.
We see lots of these absolute type benchmarks. I mean, you know, a decade ago we saw none of these, and it was all kind of relative benchmarks. And whereas today there's lots of funds kind of in the CPI space. Again, I say what I said last week, and that is that you need it from, you know, once people retire, you know, you need to at least make sure that your money keeps pace with inflation, and this has kind of become very, very popular in the industry. So, okay, the Atlantic Real Income Fund. Its manager is Arno Lawrence. He's been on the show with us today. The information date there is July 2009. A small fund still, but I mean that's part and parcel because of the late inception date of this fund. It's not a very old fund, and it's only at about 35 million. Benchmark there is CPI plus 3 over rolling 3-year periods, and then a total expense ratio of about 1.33%. Just to give you performance numbers here, the Real Income Fund 10.82% over the last year. That's net of fees relative to CPI plus 3 of 7.57, and then if you look over 2 years, 8.48 versus 7.59. Let's look a little bit closer at some returns. You start getting used to the way in which we look at returns on this fund. What you're looking at over here is, in essence, the return for the fund, and that's the fund's return relative to the benchmark that you read off the Acsis on the far end over here, and its benchmark, which in this case is CPI plus 3. Now again, I say that this is a very short period of time. Usually what we try and do is we try and look at funds over 5 years, but we'll come and review this fund again in 12 months' time. The fund's relative return to the benchmark, you see some underperformance during the period of 2010, which is over here. It's evidence on this side over here. And you see that flips over to a positive performance or an outperformance relative to the benchmark here during kind of 2011. And if you're looking at the line over here, you see the rolling return, and that's CPI plus 3. Maybe Arno can start by just talking a little bit through some of the underperformance that happened in this space over here before the outperformance started happening. Arno.
The underperformance that we had was at the beginning of the fund in terms of setting up. So it was to start with a small fund. But I think perhaps the key thing there really was the fact that this is a fund which needs to go through an inflation cycle. So it's an inflation-themed income fund built around the use of inflation linkers. The underperformance at the time was at a time when inflation was relatively higher. We were still going into the period in which inflation went down to 3%. So when you added on the 3%, the money market yields, for example, that were available were less than a CPI plus 3 type a return. So it was a case of the instruments we could use, which were fairly low-risk instruments, because at the end of the day, it's an income fund. So we are not trying to go out there and use whatever instrument is possible. It's trying to maintain a very good downside risk pattern in terms of minimizing that. But as the fund goes through as the economy goes through the inflation cycle, we believe, and I think it's been shown now, that the fund itself can deliver through the cycle of investing appropriately, not just for a 3-month period, not just for a 6-month period, but for a 1-year to 18-month type of investment horizon. And you've seen that most recently coming through now.
Arno, can I just chip in? 6 months ago, we were quite worried as investors about the fear of inflation and, you know, all this quantitative easing globally and locally to some extent as well. More recently, we're now talking about a slowing kind of growth globally with the whole unwind in the last few months. How have you positioned the fund in terms of capitalizing on this? Because it's a bit of a confusing market at the moment. Are we going into deflation or inflation? What's your view?
Yeah, it's been a dramatic turnaround, in fact, in terms of inflation expectations. If you go back barely 3 months ago, the consensus opinion was that we were going to increase interest rates before the end of this year, and that was on the back of inflation, which was heading up to, you know, breach the 6% upper level of our inflation targets. And the most likely story would have been that our interest rates were going to go up by 1.5%. Today, the market is now priced for a rate cut, and the market's expecting rates in South Africa to be cut before the end of this year probably by 0.5%. And all of that has been based on this turnaround in particular in Europe and in the US, that growth is going to slow to such an extent that commodity prices will fall, and there will be the concomitant knock-on effects into the South African economy to the extent that the upside worries in inflation in South Africa have dissipated. Jill Marcus herself, as governor of the Reserve Bank, also pointed out that monetary policy in South Africa will respond appropriately were the global outlook to deteriorate. We think that's the right approach, and in fact I think she's been completely on the ball and honest to the market. And the market has responded appropriately.
So, Arno, then, when it comes to asset allocation within your fund, then tell us about how you've reweighted the fund to all these factors that you're alluding to. And this is all basically new information that we're getting. We know the forward rate agreement market is perhaps pricing in an interest rate cut. We know that interest rate hikes have definitely been moved out to the later part of next year. Tell us about asset allocation and how you've reweighted your portfolio relative to the information that you've just given us.
Yeah, one of the things that we've done in the fund is, in terms of protecting the downside risk, is to say where can we get our best real returns with as little downside risk as possible. And you will see within the fund is that we do have a very big component of money markets. Now that money market component, it has varying maturities all the way out to 3 years, for example. So there's a constant liquidity that comes through. That's the one benefit. The second benefit is we've overlain that with credit. And in this part of the cycle where interest rates are at their lowest, even though the economy is not humming along precisely, but it's a good space for credit. So we have been able to boost the underlying money market return with a credit overlay. That has taken us to get to our CPI +3 type target with very little downside risk, because all those money market instruments are on an accrual basis, which means that they basically accrue interest every single day, a little bit every single day. So minimize the downside risk. Inflation linkers, we've slowly but surely been cutting back on that. Why? Those yields have been dropping. We believe that slowly but surely they are getting to beyond fair value. Nominal bonds, you will see that we have very little exposure to nominal bonds. And only recently we've now gone back in again. That's probably not reflected in the charts. Again, there it's a valuation perspective. We've said we want to have a tactical approach to bonds, not a strategic one. As far as property, yes?
Yeah, we're almost out of time. We have very little time left. Arno, if you could just wrap up your thoughts, and then I'd just like to get last comments from Roland and Cobie. So a few seconds I give you.
Sure. The one thing I'll say is in the fund you can see we have about a 15% exposure to equity. I'll point out that those equities are not meant to be this scatter approach to equities, as in all equities will outperform inflation over time, but rather they're very targeted equities which are highly correlated to drivers of inflation within the South African market. That's the approach that we use within this fund. It's not a normal absolute return fund. It's a low risk, inflation themed income fund.
Fantastic. Cobie.
I mean, Arno's been in the market for, long periods of time. You can see the methodical thought that goes into kind of setting up the asset allocation, understanding the different asset classes. And I mean, he's here within a bond space today because we're talking about bonds, but you can see him and how he kind of extrapolates the thinking and valuing an asset class right through all the other asset classes in order to build something like this. So yeah, let's watch the space. I'd love to have him back on the show in 12 months' time and see how the performance has kind of panned out.
Roland.
I think we generally, because of inflation fears at the moment, or uncertainty, we're going to have a bumpy ride with all of these CPI plus funds, but I do think that we do need to give Arno credit here for getting through an inflation cycle before we can really
Absolutely, and his fund has been outperforming. So fantastic, gentlemen. We have to leave it there, but thank you so very much for joining us on this edition of Wealth Quest.